Hello and welcome to the Weekly Forex Outlook at XM.com. Next week, as the tariff war continues to heat up, we'll get the U.S. jobs report and Eurozone inflation data, as well as a decision from the Reserve Bank of Australia. I'm Maria Bashir, and joining me to discuss all this is lead market analyst Rafi Bouyadjian. So Rafi, let's start in the U.S., where Trump continues to make changes to his tariff stance. Can you tell us a bit about these reciprocal tariffs due to be announced on April 2nd and how markets might be affected?
Yes, we are getting the much-awaited details regarding the reciprocal tariffs, which has been basically in the headlines almost every day. So these were initially designed to basically take into account the additional tariffs that U.S. imports face going into other countries. For example, in the EU, the EU charges VAT, but of course, this is consumer tax on all goods, not just U.S. imports. So that was questionable, what was the reasoning behind this. But of course, Trump has a habit of changing his mind constantly. And we are now hearing suggestions that, the reciprocal tariffs won't now be taking into account non-tariff barriers that other countries charge on U.S. imports. But it's basically mainly designed to address the rebalance or the imbalance, rather, regarding the large trade deficit that the U.S. has with certain countries, and of course, and now we're hearing this talk of the dirty 15, which is basically the 15% of the countries that have the biggest imbalances, trade imbalances with the U.S. So these countries, which includes now of course, China, Mexico, Canada, possibly South Korea as well, and the EU, and maybe even Japan. So these countries will potentially face steep tariffs, whereas other countries that don't fall into the top 15 might actually face fewer tariffs. So we're going to have to see what the details are going to be. But Trump is calling this Liberation Day. It's basically the big one, as the White House is calling it, in terms of all the tariff decisions we've had so far. And so this has the potential to really, cause a lot of volatility on April the 2nd when we get the details. Now, markets, of course, this week have been... We've seen a fairly decent rebound, or at least on Wall Street over the last couple of weeks. We've seen some improvement of risk sentiment, but there's still a lot of uncertainty. And there's a risk that, of course, we could see the sell-off accelerate next week in terms of risk assets. But there's been some relief that, maybe Trump might be more lenient than we've were led to expect in terms of the rhetoric that was coming from Trump and other officials from the administration. So if we get, a fairly lenient or some kind of a measured response in terms of the reciprocal tariffs, then that might actually be positive for the market's positive risk sentiment. Maybe not so much for the dollar. The dollar could actually maybe, come under pressure from strong risk appetite, but it could also rally if it looks like the U.S. economy won't be affected too badly. So it's kind of difficult to predict how the dollar will react. But on the whole, I think it's going to be a pretty big day for the markets.
Now, taking a look at the upcoming U.S. data, we'll get the ISM manufacturing and services PMIs on Tuesday and Thursday. And on Friday, we'll get the non-farm payrolls data. What are we likely to see there?
So, of course, the labor market is in focus, maybe a little bit more than inflation, because we know that inflation is taking a bit of time to get back to the Fed's 2% target. And the only way the Fed is going to cut rates sooner than expected is if we see some kind of deterioration in the labor market. We haven't seen that yet. So far, the U.S. economy, despite some signs of a slowdown, it's holding up pretty well, and so is the labor market. But but we are seeing a gradual slowdown. So we had seen the US labor market at about 151,000 jobs in February. We could see a smaller figure of 128,000 in March, and this is because we're probably going to now start to see some of those job cuts, the government job cuts that Elon Musk's department, the Department of Government Efficiency, has been making since the start of the year. So it's going to be interesting to see what government payrolls, we're going, if you're going to see a big drop in government payrolls, and then to what extent would these job losses be replaced in the private sector. So this is going to be in the spotlight. We're probably going to see a slight uptick in unemployment rate from 4.1 to 4.2%. But should we get a much worse than expected jobs report, I think investors will probably get carried away and start pricing in a Fed rate cut, possibly as early as the May or June meetings, and that would of course be quite negative for the greenback. As far as the ISM PMIs, I think those are going to be important too, because of course these give us an early warning sign if there's anything happening in terms of deterioration in employment, in hiring, as well as, of course, price pressures if they're coming down or if they're going up. So, of course, the two PMIs, the manufacturing and service PMIs, will probably set the mood ahead of Friday's jobs report.
Moving over to the Eurozone now, the flash CPI estimates for March will come out on Tuesday. How might this data impact the ECB's next moves and the euro?
So we've been hearing from ECB officials that, maybe it's time to pause the rate cuts. And from the last meeting, we heard from Lagarde as well that, maybe it's time to slow down the pace of rate cuts because, of course, the last few meetings, we've been getting back-to-back rate reductions. However, since the last meeting, we have, of course, had, some fresh tariff announcements from Trump in terms of the steel tariffs, steel and aluminium. And more recently, we had the auto tariffs, and this is of course a huge blow for the European car industry, especially Germany's car industry, and so this has led investors to price in a higher probability of rate cut in April. Probably now at the moment it stands as close as 90%. So should we get some soft-ish CPI data, shall we say, I think that would only sort of strengthen the case for the ECB to cut rates again at its April meeting, and that could potentially pressure the euro a little bit. But of course, we are seeing, Eurozone inflation also kind of take its time to head back to 2%. So, we shouldn't be too surprised if there's a stronger than expected figure, and that might see investors pare back their expectations of a rate cut in April. Potentially that could be positive for the single currency.
And finally, over in Australia, the RBA cut rates at its last meeting in February. What do you think the central bank will do this time? And how might the escalating trade war impact the RBA's next moves and the Australian dollar?
So we had, of course, that rate cut from the RBA at its February meeting. They took their time to cut rates. They were really late in the game. But despite that, it was a very hawkish cut. So basically, the message we got from the RBA is that this was a one-off cut. Don't expect another cut anytime soon. Since then, however, things have kind of as we've been talking about, escalating in terms of the trade war. Now, although Australia doesn't seem to be the target of the White House, at least not just yet, and they're good at negotiating with the US, so they were, I think, already or might get some exemptions in terms of the steel and aluminium tariffs. The main problem with Australia is that its biggest trading partner is China, and China, of course, is under attack from Trump's tariffs. So the RBA might be mindful of this and might kind of be more cautious as far as the global impact of tariffs on the Australian economy. And so we might get a slightly more dovish tone, and that could potentially bring the Australian dollar under slight pressure in a more dovish scenario. if should the RBA potentially open the door to the possibility of a rate cut as early as the next meeting in May, because markets don't expect one until the meeting in July, that would be seen as even more dovish, and that we could see the Australian dollar really suffer in that scenario. But more likely, we're just going to get a slightly more dovish language coming from the RBA. But in terms of the decision itself, they're expected to hold rates.
Rafi, thanks so much. This was the Weekly Forex Outlook here at XM.com.